me thank everybody who joined us today, and of course to our panelists and to Winston and Strawn for their tireless support of the American FinTech Council. My name is Phil Goldfeder. I'm the CEO of the American FinTech Council. The American FinTech Council is the fastest growing and largest trade association that represents both FinTech companies and innovative banks. We're at the forefront of policymaking in Washington, D.C. and in states across the country. We are really, really excited. Every single month, we try to bring together some of our members, some leading industry experts to talk about the latest and greatest regulatory policy industry news. We've continued to grow and just so excited for the continued participation of our panelists and, of course, to everybody who attends. I am super excited, not just because I've heard Juan and this panel and everybody on this panel present a number of times before, but the subject matter is just so relevant. And I wish I could say that what you take away from today is something that you can hold on to, but I think we all know that it is ever evolving. And what happened yesterday is different than what happened today and is likely going to change tomorrow. And so I'm hopeful that this panel can encapsulate a bit of what has been going on in Washington with the new administration, with the various changes. Just this afternoon, Jonathan McKernan had a confirmation hearing before the Senate. And so every single day, the world continues to evolve in this new administration. And I'm really excited for this panel to tackle that. And there's nobody better than Juan and the amazing folks at Winston and Strawn to lead the conversation. So Juan, thank you again for your friendship, for your partnership, and for everything that you have done, not just for the American FinTech Council, but obviously for the entire FinTech ecosystem. So thank you.
Thank you, Phil. I appreciate it. And it's great, always great to see former colleagues, and both on the phone and in real life, of course. I'm Juan Azel. I am the co-chair of the FinTech Banking and Payments Group at Winston and Strawn. I welcome you to this webinar. We have a lot of people on the line, and I think it just shows the interest around this topic and the dynamic nature of how things are changing within supervision and enforcement and everything banking related, given this new administration. We have an incredible set of panelists here, which I will introduce in a second, to really have a discussion here. There are no slides here. There's no PowerPoint. We really wanted to have a discussion amongst individuals in the space, that actually do the work that we do, and we thank for a lot of them who are clients, to really let us know from their perspective and their experience what all of this means. And we have a few points that we want to hit on during this webinar, and we're going to hope to get to all of them at the end. But questions, I love questions. I moderate a lot of panels, and the more questions, sometimes the better. So if you have any questions, please drop them in the chat. We will do our best to save some time for in the end to have and try to answer some of your questions and give you our thoughts. I mean, we're all going to have a crystal ball here. Let's just be clear at that at the beginning, right? A lot of this is just not only uncharted territory, but we just don't know how it's going to turn out. But I think from that perspective, we can do some educated guesses, right? That maybe more so than that, given the experience that we have. So without further ado, let me introduce our panelists. I'm just going to go left to right. Pam.
I'm Kaur. I'm the head of bank technology at BankTech Ventures. We're a strategic investment fund backed by over 100 banks across the U.S. And we invest in bank-enabling technology companies. And in my role specifically, I help our portfolio companies that we've invested in figure out how to work better with the banks in our fund. And a large part of that is how they can align better with the regulatory requirements that all these agencies put forward.
Great. Alastair?
Hi there, Alastair Wood. I'm the general counsel of Raisin US. We are a deposit marketplace connecting 80 plus banks across the US with hundreds of thousands of retail depositors. We're part of the larger Raisin group, which is throughout the US and Europe, with approximately 200 banks on the platform and 70 plus billion in assets.
Rob?
Hi, I'm Rob Lavet. I recently retired as general counsel of SoFi Technologies. I was at SoFi from the beginning of the company in 2012, so saw the evolution. And at SoFi, I led and built the legal team, and I had management responsibility for compliance, AML, government relations, regulatory relations, and privacy. Upon retiring from my GC role, I'm still on the board of SoFi Bank, which is the national bank subsidiary of SoFi Technologies, which is a bank holding company. And SoFi Bank was created in 2022. We acquired a small community bank, national bank in California, then went through the arduous task of getting approval from the regulatory agencies, became a bank holding company, and the bank grew very, very quickly. It's over 30 billion in assets now. So we were originally in the community bank section, and now we're a regional bank. So it's seen a lot of growth. And I also am an advisor to a number of fintechs.
Thanks, Rob. And finally, Carl.
Thanks, Juan. Carl Fornaris. I co-chair the financial services practice at Winston and Strawn, and with Juan, the fintech banking and payments practice. For our bank clients and our fintech clients, we help on licensing, new product launch, mergers, acquisitions, capital raising, and then supervisory and trouble examination issues and questions.
Thanks, Carl. All right, so let's go right through the first question for the panel. We have new agency heads across all of the agencies, right? Some are acting, some are being nominated, and I'll just go through them real quickly. We have our friend Travis Hill, right? A friend to a lot of us, especially at the AFC, who's the acting chair of the FDIC. We have Rodney Hood, who's the acting controller of the currency. Jerome Powell will be the remaining chairman of the Fed, as far as we know so far. Things may change very quickly. But it looks like through at least 2026. But more importantly, the vice chair of supervision, Michael Barr, should be stepping down on Friday. At least it was announced. And there's rumors that Federal Reserve Governor Michelle Baumann may take over. That's very important for those member banks because the vice chair of supervision, obviously, is the top cop at the FRB. And finally, we have Jonathan McKernan, as we discussed, I think, earlier, who's been nominated to serve as director of the CFPB, who's currently sitting, unless they're in recess, in a confirmation hearing today. And I do have to repeat one comment that Senator Warren said to him. It said, it kind of feels like you've been lined up to be the #1 horse at the glue factory, quote unquote. So on that thought, I will turn it over to the panel. Whoever wants to speak first. Sometimes I'll direct questions to you specifically, but this is such a general question that I wanted you to get your thoughts. What do you think about these new agency heads generally? What can you tell us about them and to the membership? And what do you think this means in particular for our industry, our fintech industry? Anyone want to jump in?
I mean, I go ahead, Alastair, and then I'll.
No, Rob, after you.
I was saying I was fortunate to have met all of these folks at various times, and I probably know Jonathan Gould better than the others, who's, I believe, was nominated for the OCC head. And, I had dealings with Jonathan years ago when he was a staffer in the Senate Banking Committee on the Republican side. I think he's very practical, very experienced, was the acting general counsel of the OCC, has been a partner in law firms, and it's been in the crypto world as well. I think McNernan, I believe, he was he was a Republican at the FDIC, was very open to innovation, and I would. And now his role seems to be to essentially wind down or shelve the CFPB, but it could be repurposed at some point, if Trump has particular policies he wants to pursue.
I mean, I was just going to add, I think it's a really interesting time because it's not just that the heads are being replaced. That happens whenever a new administration comes in. I think what's interesting is you have people below the heads being replaced. You know, the head of enforcement of the SEC is out. FDIC's supervision head is retiring. And on top of that, you have, I mean, the FDIC, 10% of its workforce has been either let go or had offers pulled back. I think what will be really interesting is, unlike other transitions, how quickly those priorities from the new heads of the agencies flow down to the line, examiners that, quite frankly, we are more likely to be dealing with and have more of an impact on our lives. Both whether those examiners, now take more heed of the political, directives, and quite frankly, are there just less of them to do the work? And what does that mean for us? And what does that mean for, how the agencies prioritize what they're going to look at?
Has anyone seen, because I've heard that before, Alastair, from a couple of clients, we've experienced it ourselves from some clients, where it looks like and I know this is important to both the banks and the fintechs, but the on-the-ground examination staff, the EICs, right? I'm not going to say have not gotten the message, but nothing seems to have changed, or certainly not significantly in terms of supervision. We'll talk a little bit about supervision and enforcement priorities a little bit later, but into the panel, have you seen either your clients or your banks itself any change at the on-the-ground examiner level? Anyone?
I mean, I can't speak too much on this because of CSI, but I think there has been a change in that some of the examiners are kind of waiting to see the dust settle. So while they're still, they haven't shut down examinations, I think, it remains to be seen. I think there'll be certainly less, regulation by enforcement in this administration.
Yeah, I would echo that I think, depending on the agency, they are in wait and see mode.
Yeah.
Like in the case of FDIC, right, as the board of directors is being reconstituted, I think, and we'll cover this later on in the panel, but certainly there's going to be a bit of change of direction there. We talked about the OCC. There's been everyone's heard buzz of the FDIC perhaps being put under the Treasury Department, and then of course the Federal Reserve and the executive order that basically takes bank supervision and regulation and puts it under the White House, which is really a watershed event in bank regulation. So that will also impact how Federal Reserve examiners examine banks. So a lot to watch out for in 2025.
Yeah, echoing those statements and just going back to the original question about the agency head changes. I know, we all know Travis Hill has been a friend of bankers for a while. And we have had him, attend recent events that we've all been at and had him speak on panels. And, those were the most sold out, room overflowing events that we've been to. But I think between Travis and the changes at the FRB, I think we anticipate a lot more community bank friendly regulation and pull back on certain things that community banks have been fighting against for a while, especially considering Michelle Bowen's seat as a community banking seat on the FDIC or FRB board prior to the potential nomination here. So I think from our perspective as BankTech Ventures and advising both community banks and fintechs, I think we're anticipating, community banks to thrive and really do well under this administration. I think what actually happens and how that trickles down, like we all kind of said, is dependent on what changes are made. In addition to that, also dependent on what is communicated down to the bank level and to the fintech level and how they interpret that, and just kind of the gap that happens there.
Yeah, totally agree with what Pam said. The concept of tone from the top, I think in Trump 1.0, there was an effort to do that, but it was not a systemic one. And so we didn't see the trickle-down effect.
And just looking at
the examination level.
Sorry, I think there was some feedback. But the day that Travis, the day after Travis Hill was appointed, you may have seen a statement where he issued some of the I guess his priorities for running the agency. And one of them that stuck out to me was a more open-minded approach to innovation and technology adoption, including a more transparent approach to fintech partnerships as well as digital assets and tokenization. How or when or to what extent that gets down to the individual examiner level is absolutely, I think, a concern, or at least a question as a panel is raising. But let's move a little bit on, because I mean, we have, from the perspective of the agency heads, we have who's in charge, and we have, as Carl mentioned, the tone for the top. But we still have a lot of regulations out there, right? And these regulations, including proposed rulemaking, which we'll discuss shortly, are not changing, right? They're not, unless Congress changes a statute or a regulation is somehow pulled back through a rulemaking, that remains to be seen. But right now, what we're seeing is certainly, and when you prepare for these panels, you sometimes have to check the news just before you start the panel, because things change, at least in this administration, very quickly. You may have seen a recent executive order just a few days ago on deregulation. It was titled "Ensuring Lawful Governance and Implementing the President's DOGE Deregulation Initiative." And I'm just going to speak briefly about this, this executive order because of its importance, and then I'm going to go to the panel. I mean, essentially, what the purpose of the executive order was to rescind unlawful regulations and regulations that undermine the national interest. Number one. Number two, to give enforcement discretion to ensure lawful governance. And then number three, which we'll talk about at the end, is the future of rulemaking, the promulgation of new regulations. But I think what was important when we talk about the regulatory environment that we're going to have is a directive from the president to agency heads that we've just discussed, and essentially directing them to review regulations and look for regulations, for example, that are unlawful delegations of power, regulations that impose significant costs on parties, and I think a key point is regulations that are based on anything other than the best reading of the underlying statutory authority or prohibition. And then finally, I mean, there's a lot, you could read this, but I think you get the picture. But the last one that stuck out to me was, agency heads see if there's any regulations that harm the national interest by significantly and unjustifiably impeding technological innovation, right? That's obviously a word that for us, that's very important. And in the second part of the order, before I go to the panel, talks about enforcement discretion. And it says essentially that the agencies need to preserve their limited enforcement resources by generally deprioritizing actions that enforce regulations based on anything other than the best reading of a statute. Again, we see that best reading, which is interpreted perhaps Scalia-esque as plain reading of a statute, and deprioritizing actions to enforce regulations that go beyond the powers vested in the government by the Constitution. So we definitely have both at least effort to rescind the unlawful regulations according to the executive order, as well as pare back enforcement discretion to ensure or to enforce their governance. So there's more in here, but obviously I want to go to the panel. This seems to be, if you read this on its face, a monumental change to the way regulations are drafted today and are enforced, as well as how banks comply, right, with those particular regulations going forward. are we reading too much into this? Do you agree that this could have that effect, or is it something else? And again, open to the panel. Or else I'm going to call you like if we were in law school.
I mean, I would say we can hope. I would be perfectly happy if all this led to was a more rational enforcement mechanism, meaning procedural foot faults don't necessarily end up with draconian penalties just because you're not a favored industry. A world in which, you know, the goal is to strengthen and improve, not necessarily punish. You know, obviously, if it went as far as this order, that would be, you know, positive. But I think even just lightening up the kind of potential downside would be a massive relief, I imagine, for most members, and hopefully alleviate some of the fear that, you know, whenever you get a call from a regulator, is this going to be, you know, them trying to shut something down? Could it be a more productive and better partnership for consumers?
Less regulation by enforcement, as I think Rob mentioned, and more collaboration is what you're saying, Alastair. That could
one can hope.
Perhaps one can hope out of this.
Yeah, I agree with Alastair, but I'd say there's an element of unpredictability because at his core, I mean, Trump is a populist. So if you think of some of the things he's floated out there, like the caps on credit card rates, it's probably, to me, very unlikely that the administration would pursue that through regulation. More likely it would be through cajoling or, you know, private negotiations. But I do think clearly, you know, the administration will look at easing capital requirements on banks and promoting innovation, probably looking for ways to get crypto into the mainstream in banking. And you've already seen, you know, the huge shift in DEI where, you know, institutions now could actually face liability for pursuing DEI initiatives. So I do think it's been pretty much of a sea change in the this short time.
I mean, I would also caution that having too little restriction may not be good for the industry, meaning if in 4 years the administration is going to change and you could end up with a Democrat in the White House, and if, you know, there is some systemic issue that arises, another SVB collapse, and it can be blamed on the lack of regulation, you may actually see regulation come steaming back in the other way to even greater extent. So there is some potential in the industry to say, let's not go too far, because that could actually hurt us in the long run. You know, take a small win rather than a big win, because we'd rather have the small win forever.
I mean, the pendulum can swing just as far as what you're saying to the other side. And yeah.
I would agree that the order is monumental. It's something that, you know, for those of you that, you know, are administrative lawyers or took administrative law, it's turning administrative law, putting it on its head. Number one. Number two, I totally agree that, you know, sort of like under the file called "Careful What You Wish For," this works well for, you know, pro-business regulation. All it takes is a change in administration, and that new administration will say, well, this is great. We now have the keys to the car. It's plug and play. We're going to make a U-turn, and now we're going to exert, you know, very forceful regulation the way we want to. You know, again, taking out the independent nature of what was the, you know, quote unquote independent agencies. And I think that is, you know, for the long-term play in this, that's what the industry has to be very mindful of, right? So, you know, in theory, these next, you know, 3-4 years could be, you know, very positive. And what I think is going to happen is we're going to go back to, you know, a sort of like a pre-2005, you know, Riggs Bank enforcement type era where enforcement actions will be issued on a much more, say discrete basis, where we'll see a lot more MOUs, perhaps on the public side, more written agreements like we used to see in the old days, and a lot fewer consent orders, a lot fewer CMPs.
Yeah.
And I think what we saw after 2005, and this is really bipartisan. It was a rapid growth and steamroll of enforcement orders by with really using them as hammers. Consent order, civil money penalty, consent order for huge amounts, and so what I think is we're going to see a rollback of that. Again, going back to pre-2005, but then again, careful what you wish for. It could all come right back and boomerang on the industry. So one to be very careful of.
Pam, a question for you. Carl's talking about enforcement, which we'll delve into it. I mean, I think our members in the AFC, I think an area that we keep hearing and from our clients as well is what Kaur just mentioned, enforcement, but even on the supervisory side, right? A lot of time spent during examinations contesting why something is not a violation of law or an apparent violation of law, or why guidance was not followed, even though it's guidance and not a regulation. And I think it's fair to say that supervision over the last few years has been a little bit more contested rather than in collaboration. From the perspective of supervision, what do you think the effect of this order is likely to be on banks? Do you think examiners are going to look at this order and say, well, we're going to focus more on those regulations that we know don't violate the law, right? Right, or don't violate the Constitution, like truth in lending, right? BSA/AML, while deprioritizing other regulations that may perhaps be newer or not have I guess that seasoning over time. What do you think?
Yeah, I think it honestly depends. One, on whether there's going to be a massive new hiring of politically aligned regulators that will follow, all these changes to the T, or whether it'll be, the same regulators that have been doing this for 20 years and have been through multiple administrative changes and kind of honed in on what they actually care about on a personal level. I mean, I also used to work at a bank for almost 10 years, went through many examinations myself. Really depended on who was coming in to examine you and what they were going to focus on and what they knew about your bank already. So I think that's going to be a huge factor in this, whether, how that messaging trickles down to the individual examiner level. And I think it's just going to be too hard to tell until we see who the administrator or who the agency heads are going to be and what their directive is. We've seen with the CFPB massive layoffs and across lots of industries at this point. So if that's going to be kind of the direction that goes here as well, and how that is going to play out, I think will be a major contributor in that. But will the existing examiners really change on that? I don't think so. I think it's going to be a lot of, kind of what we mentioned, like, oh, it's going to be 4 years from now, it might be different again. So like, should I, as an individual examiner, or even, examiners in certain areas, really care to try to change that? I'm not 100% convinced that will happen, but stranger things have happened so far, so who knows?
But I think one practical point from what you said is that there are going to be less people at these these regulatory agencies. So it's going to be hard, I think, for the regulators to get all the specialists to come in on these regulatory exams. That's just going to be a natural consequence, of the decreasing of the federal workforce that's hitting, and you may have like experienced people leaving the government looking to go to the private sector. That may accelerate. So I think those are important points as well.
Yeah, and I wanted to go back to the original question a little bit as well. I think we're hoping that this is going to be a monumental change in how certain regulations are pushed forward, such as in AI and crypto. Those are hot topics, of course, in the fintech industry forever. So I think in that perspective, yes, we're hoping that this is a monumental change in how those things are regulated and communication around those things happens. But again, also going back to the pendulum shift, like, will we shift back too far and cause ourselves to be, no longer being safe and sound and whatever, however we want to define that. So like, how far are we going to go back to pre-regulation? And I think those are all still going to be big questions in the air that sadly I cannot answer today, but hopefully maybe tomorrow.
We all have, like I said, a crystal ball here on that. I like to say that there's Carl's probably tired of me saying this, but that there's a fine line between supervision and enforcement, right? Is that when you do this long enough, you start hearing a regulator and they start using kind of few key words where you think, oh, this is turning into a bigger issue than just a finding, or even a MRB or MRA on your ROE, right? To Carl's point, question for you, Alastair. In terms of enforcement, what we have seen in the last 3 years is I think a very aggressive enforcement stance, whether you call it regulation by enforcement or whatnot. I want to go back to your comment, but I think it's very important about collaboration. Do you think something like this change in the prioritization of regulations for enforcement could lead to a more collaborative situation with examiners, and therefore lead to, as Kaur was mentioning, more MOUs and less consent orders?
I think it's probably a combination of a couple of factors. I think it is, kind of the tone from the top, but I also think, and something I have already heard from colleagues, is there is already more willingness where people feel examiners are overstepping to say, well, I'd like a meeting with, the supervisory team, or I'd like a meeting with DC. In the past, I think that was viewed as, that's not going to get me anywhere, and it may actually end up making things worse. I think that is just another factor that I think may make the exam teams more interested in being more collaborative on the ground, and it's to everyone's interest. No one benefits when those things happen, and if you get to a point where people are too far apart, you end up forcing people's hand, and I don't think that's good for anybody. I hope that kind of willingness on the regulated party to push back and say, I disagree, coupled with maybe a bit more willingness to listen on the examiner side, leads to an outcome where hopefully there is less of the consent orders and more of the MOUs, which I candidly, I think is better. I think it is better for the industry, and I think it's actually better for the consumer. It resolves issues. It ends up not having them drag on forever. And it focuses on fixing the problem and preventing it going forward, rather than forcing a bank or a regulated entity into dragging something on because the outcome is so negative. Like, I cannot have a public consent order, so I have to fight this for months.
That's the aspect of it, right? The public aspect. Sorry to interrupt you, but the public aspect is so critical, particularly if you are public, you're held by a public bank holding company.
Yeah.
And a lot of times you don't, there's no need for that, right? You can get to where you want to go with a informal enforcement action and get the bank to react.
I have seen many times where, when I was in private practice, a bank or financial institution would be perfectly willing to do exactly what was being asked of them, but the public nature of the public shaming was the part that was really hard for them. They may even be willing to go farther, just to kind of put it behind them and move on. And I'm not sure. I question whether the public shaming aspect, and I guess the regulator would say the deterrent effect of that, is as valuable as the collaborative approach of how do we actually fix these issues, if there are issues, to protect the consumer.
Yeah. Carl, a question for you following up on that, and you know, you and I have probably done over the last 3 years more appeals of material supervisory determinations and white paper responses to proposed enforcement actions that we've probably done in the 10 years prior. I think that's indicative of something that Alastair is saying with respect to fighting back, right? We certainly have seen banks fighting back against what they seem to be enforcement actions that are heavy-handed. Do you see that continuing going forward, particularly in light of this under this new administration and this new deregulation executive order?
Yeah, I mean, I think the good question that on the supervisory side, I think you have a lot of examiners that, and really it's an entire generation that have been trained a certain way. And I think it's very difficult, you know, to untrain them or you know, teach them to write up issues in a different way. I think from a policy level, you're going to have certainly managers above them and enforcement people looking at things more differently. If for any reason they are much more accountable now to the White House than they ever were. And so I do think we're going to see this return to a lot of non-public type enforcement action, right? Informal, a lot of MOUs. So things that would have become formal or public, which is, as Alastair said, right? That's the one thing really that worries a bank the most is, you know, the public perception, having to deal with third parties, having to explain to larger creditors and or investors. That is hurtful to those institutions. Not to say that an MOU is not hurtful. With an MOU, they still have to do what they have to do, but it's not public. And so I do see that we're going to be heading toward that direction on issues that go above, you know, a MERBA type issue.
Maybe I could ask one question for you guys. You know, there's been a lot of talk of an independent appeal process outside of the regulatory agencies. That would seem to run in some ways counter to a lot of these executive orders, but at the same time would also seem to align with the viewpoint that maybe the regulators have, that the lack of kind of due process is unfair. Do you think we will see something like that in this administration, or do you think that is one of those things that will just be continued to talk about?
I love Alastair asking a question of the moderator.
Anyone. I'm just curious whether, you know, people have talked about it for a long time. I'm just curious whether, you know, with this administration, do we think we'll actually have some sort of, you know, appellate process outside of the regulatory body where where challenging it doesn't become as, you know, binary?
I mean, I will step in and as a moderator and answer that for my side. I think there's a chance of that happening. Right now and for years since the Regal Act, the appeals of material supervisory determinations, which is essentially, you know, most of what gets appealed are ratings, examination ratings. You know, you can go through the FDIC SARC or initial review panel by the Fed, but it really is a very one-sided process, as you mentioned, Alastair. You know, it's a, you know, the reviewers are appointed by typically the agency, and it's almost like the agency saying, well, you know, Congress told us we have to do this, so let's do this. And I think when we've looked at this in the past, the percentage of banks that actually are successful is so minuscule that it's almost you almost cannot even you know, calculate it, right? It is very, very, very low. So because of that, I do believe that that's a possibility. However, what from my perspective, what I'd like to see is, again, going back to what you said before, we wouldn't even get to this point, right? We have a supervisory issue and we can resolve it together with the regulator and short of a formal enforcement action, right? More collaboration at that level rather than, you know, I always say that what's happened over the last 3 years is that, especially in the fintech industry, is that it feels sometimes like that you're flying a plane while you're building it, and then the regulators like the FAA sitting there citing you for everything you get wrong, right? And making it coming down on you instead of helping you, right? Develop and come up with best practices for some creative products and services that are really helpful to the industry. But they're so creative that in some cases, risk management practices around them are not necessarily as evident as it would be for traditional banking products and services, right? Anyone else want to answer Alastair's question on that point, or we move to the next one? All right, let's go to the next one so we can get to some of the last things that we have. Let's take a look. Okay, we talked about rules, right? But we haven't talked about the final and proposed rules, right? There's a ton out there, right? That happened just before the new administration took place. We could spend all day speaking about these rules, but I kind of want to get your thoughts in kind of like a lightning round format of which of these rules that are out there. Again, some are proposed, some are final. And by the way, the proposed ones can be, as just for everyone's benefit, can be withdrawn or abandoned. Final ones, depending on when they became final, can be rescinded under the Congressional Review Act. But if it's beyond the period of review, it'll take a notice and comment rulemaking process essentially to rescind the rule. But each one of these could essentially be rescinded. So I'm just going to mention some rules and see your thoughts on it. Probably I was going to say not in no particular order, but this is a big one. Although I think most people think it's that broker deposits, right? The rescission of the modernization of 2020 broker deposits. Do we think that's dead?
Yes. Yes.
Yes.
Pretty much not going to happen. I think that's pretty clear. All right, and I'm going to get a little bit of a harder one. Open banking, CFPA section 1033. I haven't heard a lot of necessarily negative things about it. I think there's a lawsuit out there. But what do you think about open banking? Yes, no? Could do the gladiator thing.
Unclear to me.
I think unclear, but bigger banks will still continue to move forward with it, and they have been. I think the banks that already were hesitant will put a full break until they get super clear direction on it. So again, also unsure, thumbs up and thumbs down.
100% agree.
Yeah, unclear. The digital assets industry certainly has an interest in that, so to be determined.
All right. What about? I'm going to give you an easy one. What about the CFPB's midnight rule on prohibited contract terms? I don't know if you guys saw that. That's probably I'm not even going to mention that. That one is pretty much it was that, but you should actually read it. I did read it, and it's very interesting. It almost reads like a case note that one would write in law school in terms of how liberty and justice for all and all of that stuff. It's a very interesting one from that perspective. That was definitely a midnight rule. A little bit of a harder one. Last year we had the small business lending reporting. You guys remember under ECOA and Reg B. This is CFPA section 1071. This would have to be a notice and comment period to rescind it, but it was a big burden, I remember, for a lot of banks, particularly some on the phone. What do you guys think about that one? Do you think that one will end up being rescinded? Any thoughts?
I don't know if it'll be rescinded, but I definitely think smaller community banks have a much more friendly voice in Congress, or friendly ear in Congress, I guess. I know, French Hill and, make community banking great again. I think the burden argument on small banks will actually be one that resonates. And obviously if it resonates with Congress, then, it may resonate with the regulatory agencies as well. Or they may force it to resonate with the regulatory agencies as well.
And last one, I just threw it out there. Now that you talk, Pam, I'm going to ask you this one directly. This is a tough one. The FPO one, right? The custodial account record keeping requirements. This is a big one for the BaaS community out here, members of the AFC and whatnot. It's a little bit burdensome. Some may say a lot. What do you think about that one?
I think it's definitely going to get challenged. I think anything that has to do with increasing regulations on the banks is going to be challenged right now. The banks have, like Alastair said, very friendly ears in Congress at the moment, even at the FDIC, very friendly ears in FRB. So I think challenged for a while, I think. It hasn't been a popular one from what I've heard.
I would take a contrarian view. I agree it'll be challenged. I think it is one where the risk of another synapse situation, knowing it's already happened once, there will be a hesitancy to be the one who says we're not going to do it. There will be an institutional reluctance and not doing something. I think more likely to be scaled back than full on repealed.
Yeah, I'll agree with Alastair on that. I think the proposal from this past September will get trashed. It will be put in the wastebasket, but something will come out. It just needs to be much less burdensome on the reporting side. I think the rule is good in spirit, and really just prudent and safe and sound banking practices is the basics of what's called for in the rule, is something that banks should be doing anyway. It's the reporting that is the killer. And I think that under the executive order is going to be completely retooled.
Yeah, I kind of feel that way about most of these, is that there are things that banks should be doing. And then maybe the ruling that came out was probably too large and will be challenged and pulled back.
And Juan, I think that under the executive order, really the agencies, not all the agencies, not just the federal financial agencies, are mandated to look at all of their regulations, and anything that is burdensome or that impairs the national interest has to be, raised with the White House.
And not only that, Carl, and this next question is for you, Rob. Moving into the last topic, what about new regulations, right? We're talking about everything that's out there, but we've got 4 years, right, at least, of this administration, and we saw how the last administration used rulemaking. The executive order talks about and really directs the agency heads to consult with DOGE team leads, which is pretty remarkable, and the administration of the OIRA on potential new regulations. Sorry?
Yeah, no, I think also there's a requirement that, for every new regulation, 10 regulations existing ones have to be examined. So to me, it seems like there's a real burden on, will there be an incentive for any new regulations to be proposed, knowing that the amount of work that's going to create and looking at, existing regulations to be pruned or rescinded. So yeah, I think there'll be a very low level of new regulations introduced in this administration, barring, what Alastair said, which is some type of big bank, or a banking collapse or another synapse type scenario, which could lead to regulation or more likely enforcement. But I think the barriers to new regulation in this administration are pretty high.
Yeah. And Rob, what do you think about modernizing existing regulations, right? Do you think we're likely to see regulations that not necessarily new, but they kind of revise existing regulations to like a broker deposit happening? I mean, that happened under the Trump 1.0, right? I think broker deposits was everything was brokered, right? If you were a bank partnering with a fintech, everything was brokered. So we got, I think the industry got something that they wanted, and now the Biden administration tried to remove that. Are we going to see some of that modernization as well, you think?
I'm going to do a little twist on your question, because it was one of my pet peeves, when I was in the space, which was, and this was really more focused on the consumer protection regulations, that a lot of them were drafted so long ago and had never been modernized, for the internet. It would drive me crazy. Like if you look at, Truth in Lending Act or look at the notice requirements, which are not modernized. So I always thought, that in particular in Truth in Lending, for example, there were these new subparts introduced, but they didn't tie together. And again, somebody really needed to go through them and modernize them from, the impact of modern technology. But that never happened. I don't know if that will happen in this administration. I do think there'll be new regulations on digital assets, with that executive order to look at digital assets. And just as a personal experience, when we got our bank charter, we had an existing kind of crypto introduction business through our broker dealer. And this is public, but in the order when we were approved as a bank holding company, we had 2 years to divest the crypto business or conform it to where it was a permissible activity. And, SoFi ended up shutting it down and transferring the accounts. But I think there's a huge opportunity now, because I think the regulators now in this administration will be more receptive to bringing crypto into the banking system. So I think that's an area where we'll, see some positive activity.
And I'm going to take a question because a great question, because it aligns to what we're talking about here in terms of regulation. Even if there's no federal regulation, new regulation, we cannot forget that there's still regulation at the state level, right, including, I think, at all 50 states, a UDAP type of regulation, right? And we saw a lot of unfair trade, undeceptive trade practices activity by CFPB, by private litigants over the last 3 years. So this particular question says, are we going to see a shift at the federal level, or will this shift at the federal level result in more regulation by enforcement on the state level, particularly Massachusetts, California, New York? Whoever wants to take that question on the state level. Anyone?
I can start real quick here. I think that's right. I think we saw it in Trump 1.0. I think we saw a very active New York State regulatory authority, the DFS, and in fact, if you recall, in 2017, the New York State sued the Office of the Comptroller of the Currency to stop the rollout of the national FinTech charter, and they were successful. They got a federal injunction. So I think you're going to see that from some of these so-called blue states to try to impair federal deregulatory efforts, and basically say, well, look, if you want to do business with our customers that are residents in New York or residents in California, et cetera, you got to go through us first. There was an effort in Virginia. There's a bill that's gone to Governor Youngkin's desk that would impose a 12% interest rate cap, and it would apply to fintechs, right, to out-of-state fintechs, which is an effort to stop fintechs from partnering with banks that want to engage in rate exportation programs. And that's, by the way, something that the AFC has been very vocal to try to fight and see if it can be stopped. But for sure, Juan, I think on the state side, we're going to see a lot going on over the next 4 years.
Yeah, I don't know.
Yeah, and I would just add to that. I agree completely with what Carl said, and we did see that a lot in Trump 1. But I think there's a dichotomy. You have to look at fintechs versus the banks, which are kind of more immune to kind of state enforcement activities. But for fintechs, and when before SoFi became a bank holding company, we had many state licenses, had to deal with all the state regulators. I would add a few other states to the list that you gave, but I won't mention them. But I definitely see the role of the states becoming more important. And so that's important for fintechs to still invest in compliance and risk infrastructure.
It always seems like the fintech is the one that gets the letter from the state AG, right, and sends it over to the sponsor bank.
And Juan and Rob, I would say also the inverse is the so-called red states. There's this populist movement going on. Expect to see state level DOGE efforts where the state administrative agencies are put under the governors, the respective governors. Very similar in a mirror image effort of what's going on in Washington. So this is all groundbreaking stuff.
I'm going to cut this conversation or this because I want to get to some of the questions. It's great, but I really want to get to the questions and then get Alastair, because we have a lot of questions, and get Alastair's and Pam's views on some of this stuff as well. So first question in the last 5 minutes, it's a great question. And it does a compare and contrast between community banks and larger banks. Which is going to benefit more from, do we think, from these pro-business regulatory changes? Or is this favoring the small community banks that have traditionally been the banks that have created fintech partnerships, whereas larger institutions usually have the resources to create their own technology, right? To everyone, do you think this will favor one or the other, or both? Pam or Alastair, to hear from you.
Depends on the regulation. Like I said earlier, I think there'll be a lot of exceptions to carve out certain things for community banking to make it, to ease the burden. So I think from that perspective, we'll see, you know, favoring terms for community banks. But I think overall, on a general level, I think the larger banks will be greater benefited.
Yeah, I agree.
Yeah, I don't disagree. I think the only thing that I think you will see is a greater willingness on the community banks to work with fintechs, which I think provides more opportunities for fintechs to be created, to spin up, to, you know, come to market, simply because there isn't going to be viewed that draconian, gosh, like if I do this, my exam team is going to like crucify me. So I think there will be more opportunities for community banks. Whether or not that turns into financial success is a whole different issue.
Yeah. Thank you. One question. I think it's a question a lot of banks out there have. Another great question. DEI, right? We have a lot of banks and fintechs with DEI initiatives still in place, right? How can, you know, banks, the management, financial leaders frame the conversation around DEI in finance to avoid political backlash while still driving equitable access to financial services? I think everyone agrees equitable access to financial services is important, but how do you frame that within a DEI initiative at these institutions? Anyone?
I mean, I think you can still say, you know, one of your core objectives as a company is encouraging a diverse workforce. It's just, I think that you can't really use the numerical, you know, quotas in that program, or you're going to risk private litigation as well from some, you know, conservative groups that are suing a number of companies that are pursuing. And then if you're a government contractor, you know, that's been the subject of an executive order as well. So it's pretty murky. So I think the banks have to walk a pretty fine line in that space, given this administration, which is why you've seen so many large companies, let's say outside the banking space, you know, publicly say we're you know, stopping our DEI programs, or we're not placing emphasis on our DEI programs.
I would agree. I think it's the numbers, like a straight numerical calculation is something that I think might get you in trouble. I've always thought of it as kind of a two-pronged. One, I want diverse opinions and diverse thought around the table. And that means having people who have different backgrounds, have different viewpoints, have different experiences, because they bring something to the table that I don't. And I've also thought that, you know, one of the most important things is you have to have a workforce that looks like your customers. And, you know, if you want to have customers from all over the nation, from every different ethnic, religious, you know, socioeconomic, et cetera, group, then really you need to build a workforce that understands those groups and can bring their unique perspective to the table. I think that's something that is universal in how you build a top-notch company, and I don't think it necessarily has to be tied to what has become, I think, a lightning rod for conservatives. I think it's just good business to make sure you have people who aren't an echo chamber for you.
Yeah. Alastair, I want to get to the really last question in the last minute because it's kind of tied to the same thing. There seems to be divergence between state level financial regulations and federal policies. I mean, you're seeing this in other areas, like whether it's immigration, whether it's trans rights, right? You have states saying something and you have the federal government saying something. The question is, how can you tailor those messages to align, with both audiences, right? While maintaining a consistent national narrative. And you're in a state, perhaps a blue state, that disagrees with a federal policy, right? How can you tailor that message? I'm not even sure there's an answer to this question, but I'll throw it up out there to the panel for the last question.
I've always thought about it as, you shouldn't talk about it in terms of regulation or government or politics. It's about your customer, meaning, you are trying your best to serve your customer and do what's right by them. And, regulators have their view, politicians have their view, state regulators have their view. But, if you can point to that your guiding principle is trying to do right by your customer and cling to that, then at least you have a way to discuss whether it's blue state or red state or state or federal or whoever, a framework that should be universal and should at least be grounded in principle and give you talking points to approach it. Obviously, all of those organizations will differ, but it takes it out of I believe in regulation, I don't believe in regulation, or I believe in this, or I believe in that.
Focusing on the customer rather than a state or federal agency, which might be a blue or red type of.
And is going to change in 36 months or 2 years or whatever. I mean, I had a conversation with an engineering team that, you whatever you're building today is going to be scrutinized 4 years from now. So you can't build for the current administration. You have to build in a way that you think will stand scrutiny for the next 2, 4, 6, 8, 10 years.
I think focusing on the customers is a great way of putting it. Okay. I think that's to Taylor. I don't want to go too much over. We're already a couple of minutes over. Do you want to should we just end it, Taylor, or do you want to just come back and there's Taylor.
I'm here. No, I think that was great. Thank you all so much for, sharing your insights and the great conversation. The recording of this webinar should be available online tomorrow. So if anybody, had to hop off early or wants to go back, it'll be available for that. But thank you guys again for taking the time out of your schedules to share your thoughts.